Hello everyone, thank you for joining us today and welcome to this Specialist Trading educational presentation. Now today I'd like to talk to you about my new two-part dynamic stop course. This is the course where we're going to be devoted simply to stop placement. Now everyone knows and has heard about stop losses and stop loss orders from the beginning of when you start to trade. So if everyone knows about it, why do most traders have a lot of difficulty when applying their stop losses? Well, we think after trading for over 4 decades, that it's really because most traders apply them incorrectly. For example, as we look at this chart here, this is one of the ways in which most traders apply their stops. As we see this chart, this older chart here in Apple, let's say that you're very bullish on this, and after your research and after your analysis, you want to buy this, okay? So you buy 200 shares at roughly 108. All right. Now, after you've purchased Apple, you say to yourself, okay, I've got to protect myself. Where do I place my stop? Well, one of the ways in which most traders apply stops is by simply picking a range amount of points. For example, you look back at the range of most of these bars here, and there are 1 or 2 points, so you give yourself 3 points to work with. That way, you figure it won't be out of the range that much. So you figure you're willing to lose 3 points. So you're long, you're all excited, you think you've given yourself enough room to risk this trade turning into a loss, and then in 2 days, you're stopped out with a 3-point loss, okay? Actually a little bit more because it gapped down that day. So you're out of the trade. You've lost money, and then look what happens right after that, okay? So the reason why we formulated this course is it's not so much that you have a faulty strategy. It doesn't even have to be one of ours. It could be one of your own, something from another educator, something that you formulated yourself. It's that your stop loss placement is incorrect. It's based on faulty and inconsistent information. So this is what we're going to emphasize in our course, how to properly place your stops and what they're based on. And the beauty of this is that everything will be one click away on the PTS Primo charting platform. This is the educational platform that really is going to make trading with dynamic stops simple. So welcome to this educational presentation. I'm excited to be talking about this new course. If you're new to my webinars, I have been trading for roughly 44 years now. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years. 9 of those years I was a specialist. That's where we get the name specialist trading. So I've traded through every market environment. I've traded just about every system, every type of trading, every style, every strategy. So in my 4 decades plus of trading, I know what works in terms of consistency and I know what doesn't. And that's what we're going to be stressing in the new dynamic stop course, what really works in terms of stop placement. Think about how you enter and place your stops, all right? We're going to go over that in detail. Plus, we're going to talk about that in this 2-part course. We're going to spend a lot of time about that and show you exactly what you're doing wrong and how to correct your stop placement. So I'm really excited about this course because this is the first time I've really had anything devoted to this. And I'm also excited about the new feature, our dynamic stop. I really think it'll help you. It'll elevate your trading and get you on that road to consistency, what you're searching for. So you'll see that today when I go into detail what's offered in our course. But before we begin, as always, we are first required by law to share this with you. So please take a moment to view our disclaimer. I'm going to share with you a lot of performance results using our new dynamic stop placement order. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Also, please remember that all examples are strictly for educational purposes only. Now, a lot of students always say, Steve, how do I get education on a daily basis? Well, the best way to do that is to follow us on Twitter. There's our handle right there. I would suggest copying that down because every day I post different information. Already I've posted about 3 or 4 things on our Twitter page. Anywhere from signals our strategies have generated, and I go into a little bit of background as to why they were generated, to little bits of financial wisdom I've accumulated along the way. So there's lots of great free education on a daily basis. Please feel free to follow us on Twitter. Now remember, we are first and foremost an educational company. That's our only goal. We're not here to tell you what we think the market's going to do. We're not here to tell you what the perfect stock is to buy or what we think is going to happen next week or even today in the markets or in Bitcoin or in a certain stock or future or commodity. We don't believe in that. As an educator, our sole purpose is to provide you with the tools and techniques that have stood the test of time so that ultimately you can make your own trading decision. If there's one thing I've learned in over 4 decades of trading, the only traders that have lasted that long, that still continue to trade, are the ones that make their own decisions. None of these traders go to chat rooms or trading rooms to find out what everyone else is doing. They don't wait for the pundits on TV to find out what they think the market's going to do or what the earnings reports are going to be or some economic indicator. They don't listen to any of that. They have a solid but simple fundamental plan that they've been using, and they just apply it to their own trading. That's it. That's how you become consistent. So what our job is as an educator is to provide you all these things so that you can make your choice as to what feels comfortable and as to what works for you. This is a job as an educator, not to trade for you, not to tell you what he thinks the market's going to do, not to have you come to a chat room where I tell you exactly what to buy or sell, but to teach you how to trade with a specialist edge. This is the same edge that I was taught some 4 decades ago and has sustained me. Hopefully it will be able to do that for you, okay? Now, in today's class, I want you to ask me as many questions as you can, but please wait till the end. I have a lot of slides to share with you, plus a lot of different things of what's going to be offered in our new course. So if you do have a question, please wait till the end. I promise I'll get to each and every one of your questions then. The only question I will answer is the most common one, and that is this being recorded? Yes, we record all of our webinars, so if you have to leave early or if you're having technical issues, a lot of times if you just log off and then log back on again, it'll be corrected. But if you're still having difficulties seeing or hearing me clearly, don't worry. You'll each be sent a link to this recording, okay? So once again, we have a good crowd here today. Please wait till the end to ask any questions. All right, with that stated, let's begin. So we're going to be talking about stop placement orders, okay? Specifically, stop loss orders. Because remember, we're all taught in the beginning, you have to have a stop. You have to know where to place your stop. You have to protect yourself. Unfortunately, we're all placing them and we're all basing this information on the wrong stuff here. It's just there's no consistency. It's not really in any way valid, and that's something that's going to help us with our trading. So for those of you who are new to trading or really aren't familiar with stop orders, let's just give you the basic definition. What is the function of a stop loss order? Okay? Well, a stop loss order designates that a stock, or for that matter, any market, it doesn't have to be a stock, it could be a future, currency pair, Bitcoin, commodity, it really doesn't matter. But a stop loss order designates that whatever you're trading be bought or sold when it reaches a specific or specified price. That's it. So it's telling you to buy or sell whatever you're trading when it gets to a specific price. Now, the objective of this stop loss order is to exit a trade either to protect your profit, so if you have a nice trade, you want to get out before you lose a lot of that profit, or to limit your loss. Let's say you have a trade and it's not working out in your favor, it's really heading the wrong way, and to get you out before it turns into one of these huge losses. That's the objective of stop loss orders. Therefore, because of the power behind this and the validity, you must always apply stop loss orders when trading. It doesn't matter if you're an intraday trader, it doesn't matter if you're a long-term investor. You have to have a stop loss order. Everyone knows this. I mean, we're always taught this as trading 101, right? The difficult part is that most people apply them incorrectly. For example, as we look at this chart here in DISCA, okay, Discovery Inc. Let's say in February, a couple of months ago, you had your strategy, whatever it's based on, generated a buy signal, okay? And look what happened. You have a really nice gain here in the price of the stock, and you're still in it. Therefore, you want to have a stop order that is trailing or at least raising itself so you can protect these profits. You don't want this to all of a sudden go straight down and for you to turn that nice profit you have into a big loss. So that's the first function, to protect your profits. Now, let's say you weren't as lucky as buying down here, and let's say you bought way up here towards the top, okay? Well, the second function is you want to minimize or limit your losses. Therefore, you don't want to buy here and be holding on to this trade and turn into a long-term investor. After that, loss happens. This is what happens with most traders. They figure they're wrong and they say, well, now it's past the point of no return. I guess I'm holding this for the long haul and I'll just hope and pray for it to turn around. So what you want to do is limit the losses. Cut them as quickly as possible when you know it's not right to be in this trade. So these are the main functions of stop loss orders. The only trouble is, as I stated, most students, including myself when I first started, were basing our orders off of incorrect data, incorrect information. Now here how most traders decide their stop placement. And once again, myself included, when I first started trading, this is the way I was taught to decide my stop placement orders, okay? These are standard stops that I would say about the majority of all traders use to apply to protect their profits or else to limit their losses. This stop price is usually based upon a dollar amount, okay? Let's say we only want to risk so many dollars of our account. So that's what determines where our stop's going to be. Or a point amount. We decide that stock shouldn't go down or up this amount of points. That'd be way out of its norm, so I'm going to place my stop a little bit beyond its realm. Or lastly, randomly. Let's say you wake up, you feel good about yourself. You feel like, wow, I'm going to give myself a lot of risk. I just feel like I have the winning touch today, so I'll just randomly pick a place where I should protect myself, okay? Unfortunately, none of these have any levels of consistency. But more unfortunately, this is the way the majority of all traders decide on how to place a stop, either basing it on a dollar amount, a point amount, or just randomly, however they feel that day. As you look at this example here in eBay, let's say you did a bunch of research here about 3 months ago, and you said to yourself, you know what, this is going to go much higher. We're kind of like in a pausing phase here, a little consolidation, but I've done my research. I'm a fundamental and a technical analyst, and I think the fundamentals are great in this stock, but we have to break out above. So if we buy, or I should say, if we close above this area right here, I'm going to be a buyer. So you've done all this research, you've done all the homework, and the next day it gets there, but it doesn't close above. So you don't jump in yet. You're very disciplined. Then look what happened the next day. So at this point, you're excited. You decide to jump in and you buy. You buy 300 shares at 59.15, right where the close is. You've done your homework. Like I said, you're very disciplined. You waited for the close above. You looked at all the strategic economic news as well as the technical analysis news, and you feel very confident. Now you've got to decide your stop placement. Well, here's where the fault comes in, because after you've done all that disciplined hard work, the stop placement is based on something that has no validity. Let's say you say to yourself, well, I've got an average size account, $20,000, $25,000. I'm willing to risk, let's say, $1,000. So I'll place my stop down here at 55.80. All right. Let's say I have 25,000 to play with. Sure, I can risk, $1,000. That'll be fine. So you're basing your standard stop off of a dollar amount. And then look what happens. In 3 days, you're stopped out. You lost $1,000. You say to yourself, well, okay, easy come, easy go. I guess I was wrong, but it's better to get out with $1,000 loss before it turns into a $10,000 loss. So you feel pretty good about yourself. And then this happens, right? So what's the lesson here? The lesson is your analysis, your research was correct. The stock did go higher. It was just that your stop was faulty. You placed it at an incorrect point based off incorrect information. Unfortunately, this is the way most traders base stops, either off a dollar, a point, or just randomly choosing an amount. So here's the problem with deciding a stop order level this way is that the market doesn't know or care how much money you're willing to lose. It doesn't. It doesn't say to itself, well, okay, this is eBay stock talking. Well, John Doe is willing to risk $1,000, and I don't want to stop that poor guy out. I know he wants a winning trade, so I won't go down that low. I won't go down to that price level because he's invested 300 shares, and I don't want to have him stopped out. The market doesn't know, think, or care how much money you're willing to lose. So it's silly to base a stop based off how much money you're willing to risk. Secondly, the market you're trading doesn't know or care how many points you're willing to risk. It doesn't say to itself, well, I only want to go down 2 points because I don't want to really go out of my range too much. So I'll only go down maybe 1.5 points, okay? It doesn't care. The market does what it wants to do. It doesn't know how many points you're willing to risk. It doesn't know that you woke up one day and said, well, the average true range for the last 2 weeks has been 2 points, so I'll place a 3-point stop down there because most likely it won't go out of that range. It doesn't know any of that information, and it doesn't care. And then lastly, the market you're trading doesn't know, or more importantly, it doesn't care how you randomly decide to choose your stop levels. It doesn't care if you woke up in a good mood that day and said, you know what, I'm going to risk a lot because I feel really confident that it'll never get down that low. So I don't mind betting the farm. I feel very confident. Or it doesn't matter if you're scared. It doesn't care if you're frightened and said, gosh, I've had 5 losses in a row. I can't risk to lose another one. I'm going to have a really tight stop so I don't lose a lot. It doesn't know or it doesn't care. So think of the market, as I always use this metaphor, think of the markets as a river, regardless. Remember, it doesn't matter what market, what time frame you trade, but think of them as a river, okay? Now, some parts of that river are very quiet, almost pond-like. They're not moving at all. Other parts have a nice current, and still other parts have a very strong, raging, rapid area, okay? The market doesn't care if you're going down that river in a speedboat or an inner tube. It doesn't care. It's going to still do the same thing, okay? The trouble is we want that market or that river to bend to our environment. And it should be the opposite. We have to bend our view to the markets. We can't expect the market to bend its view to us. So we have to base our stops off of what the market is doing, not off of what we want in terms of a point loss or a dollar amount or just a random choice. That's where the trouble comes in. See, all traders want the market to accommodate them. We've got to do the opposite. You've got to turn your thinking around in your mindset and be able to accommodate whatever the market wants to do. So this is where dynamic stops come in. This is where Pro Trader Strategies and myself formulated this, because dynamic stops are specifically based upon market behavior. They're not based upon a specific dollar amount. They're not based upon points or a specific point pattern or price pattern, and they're not based on any type of random feeling you may have. It's market behavior. After all, that's what you're trading, right? The behavior of the market, whether the behavior is positive or negative. So you should place your stops according to that behavior. So let's look at the same example again in eBay, okay? So let's say we still, we had the right decision. It was right to go long. We bought 300 shares at 59.15, but here's how the environment would have changed with the dynamic stop. On our platform, you would have simply clicked on the top left-hand corner, dynamic stop, and you see right here a series of stop losses. Now you can decide for yourself which one you want to take, because it'll go back in time as far back as you want, all the stop loss points with the stop. And, if you wanted to have a very large stop, you could go back 4 stop loss points. Or if you wanted a very moderate one here, or the tightest one would be the last one right here. Let's say we chose this right here. All right. Now let's see the trade unfold. As we see, we came down the next 3 days, but we came down to the exact same spot. So we're basically still in the trade. Now, sure, we have a loss going on right now, but we're not stopped out. Now, as the trade unfolded, we went back up. We still have a loss, but we've moved our stop up now. Why? Because we're tracking market behavior. And then ultimately, the stock did. We had the perfect analysis. We were correct. Stock went up about 5 or 6 points, and we're still in the trade. Or we could decide to get out with a profit. It's up to us. Remember, you are in charge of your trading. Our job as a trader is to listen to the market, decide what it wants to do, and then jump on board with it. And it's the same way with the stop losses. We do not put in our own mindset as to what we think is going to happen. We follow the market's behavior and let that decide. Now, is this 100% foolproof? This means you'll never be stopped out? This means you'll never have a losing trade? No. Because, the market is free to change its mind and its behavior. And sometimes when it does change, you're stopped out. But we strongly feel that this stop placement is much better than any other stop placement on the market, or all the old and outdated ways in which you're applying your stops right now. So the PTS dynamic stop is a proprietary stop placement formula that moves with the ebb and flow of price and is specifically designed to track the behavior of the market you are currently trading. So even though the majority of the slides you're going to be seeing today are based on stocks, remember, it makes no difference if this were a 5-minute chart of the British pound, or if it were a weekly chart of Dogecoin, or a monthly chart of soybeans. It makes no difference, because the dynamic stop is so sensitive, it's able to decipher what the behavior is, and then it adjusts the stop accordingly. All right, this all leads us to the new course we're going to be having, which I want to be talking about. This is our new 2-part dynamic stop course. And we say 2-part because it's broken up into 2 parts. The first part, as you'll see here, is we're going to be talking about basic issues. The second part is more advanced, and we're actually going to be talking about a more advanced way to actually trade with the dynamic stop. So let me share with you what the 2-part core curriculum really is. In the first session, we're going to be talking about dynamic stop overview and application. We're going to be talking about the foundation of stops and a basic overview and application of this new feature. Now, there are many issues that students have told us they have difficulty with stops, okay? I mean, there's literally dozens. Let's just pick here the top three. For example, issue number one, most students tell us my stops have far too much risk. That sound familiar, right? A lot of times you're in a trade and you say to yourself, gosh, I wish it would have gotten me out sooner because I lost a ton of money holding and waiting for that stop, and it finally got filled and I lost a ton of money where I wish I would have got stopped out with a smaller loss. For example, as we look at this chart in FUTU, let's say, this was just a month ago, let's say that you're seeing this and your particular strategy is based on breakouts and you see this nice downtrend here. So you want to buy it on this breakout. All right, so 2 days after that, you have a close where it closes above the breakout. So you decide to buy. Now, even if you're using some, higher than conventional wisdom, you say, well, most likely the stop is right here because, this is a basic bottom. Most likely the institution's bought here. There's some major support, a Fibonacci support, so I'm going to place my stop down here. The only trouble with that, I mean, that's very logical, and there's nothing wrong with that. The only trouble with that is that look at the distance. You're basically buying anywhere from 160 to 165, and that stop is about 45 points lower. Okay, that's a lot. 45 points. That's roughly, maybe a third or a quarter of the value of the stock. So, that's a lot to risk. Let's say you had bought it, or maybe you bought the calls or some type of spread with a bias to the upside, and you're excited because you think, okay, I'm going to make some good money here. The market's strong, and then look what happens. Now you got stopped out, and for all you know, it went way lower. But the point is, look how much you lost. Look how much you risked. So a lot of strategies have a lot of risk behind them, all right? And if you don't have a big enough account, you may be wiped out in 2 or 3 losses in a row. Now, what happens when we apply the dynamic stop? Click on the dynamic stop, and we're automatically given the last 3 setups here, okay? Now, you can choose which one. Now, this last setup gives you the most risk, and it's basically the same stop as your idea of a stop was. You have the moderate one here, and then you have the last one, which is the most tightest. So if you don't want to risk that much, we would suggest using this one. And ultimately, you did get stopped out, but this goes back to the old premise. Remember, the objective of stop loss orders is to protect profits. Unfortunately, you didn't have a profit here, but it's also to minimize losses. So you minimize this by exiting here, and instead of losing 45 to 50 points, you lost maybe 10 points, which is manageable. It'll give you enough to come back and trade another day. All right, let's look at another example here in United Airlines. This was just a couple of weeks ago. Let's say your analysis, your strategy says this is in a clear-cut downtrend. You're waiting for a signal to go short. You don't like this. You want to short the airlines. Okay, whatever you feel, that's fine. We don't care. We're not talking about strategies today. We're talking about protecting whatever strategy you're trading. All right, so you look at this and you say, okay, we're in a downtrend. I need a sign to go short. And then a couple of days later, what do you have here? Let's say you're a candlestick trader, and this is a bearish engulfing pattern. So you're all excited now because this is giving you the go-ahead to go short, roughly about 57 and a half. Okay, oh, I'm sorry. Actually, if you're short on the close, I'm looking at where that entry is. More likely, it would be closer to 55. All right, so where would you most likely place your stop? Well, it would most likely be up here, right? Unfortunately, that's about 5 or 6 points higher. And let's say you want to buy, or should say short a couple of thousand shares. You don't want to risk that much, okay? 6 points. So applying the PTS dynamic stop, you see here that it generated 2 for it. Here are the 2 buy stops. This one is going all the way back. This is the most dynamic one in terms of risk. But look at this one, okay? So you say to yourself, well, listen, I didn't want to risk this much, so I'll take this. So you continue to short what you wanted to. You place your stop order here, and you have a very nice, I would say about a 2 to 1 risk reward ratio, or even a little bit more, because now you only risked maybe 2, 3 points tops. All right, let's go on to the next issue that students tell us about. They say, Steve, I want my stops to keep me in a winning trade as long as possible. I mean, too many times I get into a trade, this is what traders tell us, I get into a trade and I get out too early. I want to be able to ride these winning trades, but I don't feel comfortable staying in because I don't know where to get out. Well, one of the easiest ways is to let the market take you out. But you have to have a very valid or consistent method that is tracking your winning trade. Because if it's not tracking it correctly, it doesn't matter, and it may still get you out too early, or it may never get you out at all. For example, as we see this trade here in Costco, let's say you went long here. This was just about a month ago in March, all right? So let's say you went long Costco. Now, clicking on the PTS dynamic stop, you would have been given two different availabilities to place your stop. One here at this level, and then one here. Let's say you took the bottom one, the lowest one, okay? As the trade unfolded, it continued to monitor all the way up, okay? So keeping you in this positive trade. That's the beauty of using this. This is the priority of a proper stop loss order, protecting profits. So whereas you may have gotten out too early, in this example, you're still in the trade. Whereas you would have gotten in maybe at 3:30, well, now you have basically about a 40-point gain locked in, okay? Works to the downside as well. Here's an example in pen. Let's say, once again, you're a breakout or breakdown trader. You see a strong uptrend, but we've closed below. That's enough for you to want to go short, maybe buy the puts or short the stock itself. So you get a sell signal and you go short, roughly about 125. Now, the most common place to place your stop would be somewhere up here, okay? And when we apply the PTS dynamic stop, it's doing the same thing. So that's common. That's the basic stop level. That's following market behavior. Whether it's your idea or whether it's the dynamic stop, they're in sync. But you're more interested in capturing profits and in protecting those profits because you really feel this is going to go down a lot from 125, and it does. It goes all the way down to 85, okay? About 40 points. And look at the stops. These were automatically generated as the price declined, keeping you in the trade. So basically, you would, at this level here, when this was example was taken on the 20th, which just a couple of days ago, you would have basically locked in, I'd see here, 102 up to 25, over 20 points profit, even if the stock decided to go right back up. And then lastly, one of the main issues a student tells us, they say, Steve, I want my stops to be auto-generated. I don't want to have to pick up the time to figure out where to place this, where I just want it to be right there for me. Well, that's why we developed this course, and that's why we developed it in conjunction with the PTS Primo charting platform, because everything is one click away. Once you click on a buy stop or a sell stop, it's there, and it'll just stay there, and it'll continue to generate these stops as the trade is unfolding. So let's look at this example here in Hal. This is Halliburton. This was the beginning of the year. Let's say your strategy generates a buy signal right here, okay? Press on the PTS dynamic stop, and here's what you would see, a drop-down menu, and because you're long, you want, obviously, a sell stop. That's where it's going to sell for you. All right, and here's where the most obvious sell stop is, right there, automatically generated. Now, as long as you have this clicked on, as I said, on our platform, as the trade unfolds over the days, over the minutes, over the weeks, it will continue to generate these stop levels. So let's track this trade. As we see it going up, it went up one bar, and now the stop automatically can be moved up. So even though if we got stopped out, you'd have a loss, it's tightened up the risk. So look, the next day, you have a nice profit there, but the stop remains the same. Now the next day, you go up a little bit higher, and then the next day, it starts to head lower, but your stop is still here. Now you always have the freedom to at least move it if you want. If say, listen, I got a profit here, I'm going to get out. It's your choice. As we stated, the only traders who are consistent are the ones who trade for themselves. But if you wanted to still stay in the trade, let's say you had 200 shares and you sold 100 up here, well, you would use this as your stop if you wanted to. And now as the trade continues to unfold, guess what? We have another stop right here. So now basically you purchased it right around there. So you, at the worst, you're going to be breaking even on your last 100 shares. And at the close here, you've got a profit. So as you continue to monitor it, now you're doing very well. And now you've got another stop here. So now you've locked in some nice gains. And then look what happens. You're stopped out. Okay? So you purchased it here. You were stopped out right here. Here's where most students say, they say, well, Steve, how come I didn't sell it at the very top? How do I know it's not going to go higher? Well, no one knows. But this is based on market behavior, what the market is doing and telling us right now. And then look what happened ultimately. So would you have wanted to wait for it to go much higher if you had missed this exit? So this is the beauty, once again, of applying the PTS dynamic stops. They're meant with two objectives: to protect profits and to minimize risk. And they're based not off some random assumption, not off how you feel that day or how many points you're willing to risk or how much dollars you're willing to risk. They're based off market behavior. Remember, think of that metaphor with the river. The river does not change for you simply because you're in a rowboat. You have to navigate it according to how it's moving, according to how strong the trend is or how slow it's going. You have to bend your view to the markets. Can't expect the market to bend its view for you. Okay, so that's what we're going to be covering in detail in session 1, basic overview and application. We're going to take it up a notch in session 2, where we're going to be talking about a more advanced way to apply it. And this is with 3 dynamic stop initiated trading techniques. And this is more advanced, and PET D is required. So if you're not a PET D user, contact proprietary strategies. They're very flexible. They may, I'm sure they would be able to give you a deal or supply you with a PET D for some minimum purchase. Also, if you do have the PET D, this is perfect because you're actually going to be able to generate techniques for buying and selling based off the parameters of the stop placement. So let me show you what I mean here. I'm going to be sharing with you 3 techniques. Now, obviously, I can't share with you what they are right now, and I don't want to really go into detail because they're very simple. And if I just gave you 1 or 2 clues here, I'm sure most of you would be able to reverse engineer them and figure out exactly what we're doing here and say, hey, this is simple. But let me just show you some of the examples here. And also, we're going to switch up things and look at some different markets because remember, you can do this with any market, any time frame. For example, here is a daily chart of the Swiss franc coming into this past week. Obviously, in hindsight, we've been in a strong downtrend. Well, technique A is designed as a continuation method using these stop placements to generate signals. And look at the signals that were generated, not based off what we teach you about strategies. It has nothing to do with buy-sell line, it has nothing to do with top-bottom 25% bar, none of those things. It's only based off of market behavior along with the stop-loss pre-designated lines or pre-designated levels. For example, a sell signal was generated right here at the top, another one here, and I believe one last one right here, yeah. So you could have taken advantage of all of these. And while you're in these trades, you automatically will see where your stop loss is because you can use the dynamic stop. So technique A is perfectly designed for capturing these nice moving trends. Now, technique B is more designed for kind of a consolidation type of market that is looking for a breakout either one way or the other. For example, here's an example of a daily bar of Dogecoin. I'm sure you've all heard this, along with Bitcoin, Dogecoin is a very inexpensive, I'm not saying currency pair, but a very inexpensive cryptocurrency that has taken off recently. Now, this technique, once again, based specifically off of these stop loss placements, is more designed, though, to get you in when we're kind of in these levels where we're going sideways. Where technique A was looking to buy all the way up here, technique B is looking for the buy signals to be generated when actually nothing much is happening. Okay? So you see when we were going sideways, when this was basically traded about 7 cents, you could have purchased all of this Dogecoin, and this was just a couple of weeks ago, okay? And then taken advantage of this huge long run here. And now, as you've seen in this last week, we've been in another consolidation range, kind of going at a much higher level. But look what happened here the last week. Once again, based on the stop placement levels, the dynamic stop placement levels. Now, I'll go a little bit more into detail with technique C, all right? I'll give you a little sample of how this is based on. Technique C is based on a type of coiling or breakout, but a very quick breakout to the upside or downside. And let me show you what I mean here. As we look at this chart in Yelp, okay? This is going back to March, about a month ago. What you want to do is click on the dynamic stop icon right here, or tab, and in the drop-down menu, obviously, if you are already long, you would automatically click on sell stop. If you are automatically short, you would click on buy stop. In this case, we're not in the trade yet. We don't know what we're doing. So here's where it's different. With technique C, we're going to click on both. And here's what we're looking for. Most of the time, you'll see a buy stop here, a sell stop here. They're kind of randomly placed back and forth, okay? But every once in a while, you'll see a buy stop and a sell stop overlapping the same bar. So what is this telling us? Over our research over the past year or so, we've seen that oftentimes, not guaranteed, but oftentimes, this is kind of like telling us there's a coil, that the market is like getting ready to spring into action. But we don't know which direction. We don't know if it's going to be up. We don't know if it's going to be down. We don't know how high or how low, but most of the time, we have a very quick, powerful move. So here's what we suggest. In this particular example, what you want to do is place either a buy stop here or a sell stop here. Now, let's say the next couple of bars, as long as we don't touch these bars, you're still waiting. But ultimately, the first level hit is the direction you want to trade. So if we kind of hovered within this range here for 3 or 4 days and then clicked on this bottom stop loss level, we would go short and place our buy stop right here to cover if we were wrong. Conversely, if we traded here first, we would automatically go long and place our stop here if we're wrong, okay? So let's see what happened. Well, the next day we traded above. This was on the 5th of March. So that would have generated some type of a buy signal in Yelp. And then look what happened. See that springing action to the upside? Now, as we go higher, look what happens. Our next stop order that's generated is right here. So we'll move our stop, if we haven't exited the trade yet with a quick profit, we'll move it right here. But look what happened. There's also a buy stop at the top. So we have another coil here, another technique C. So we have an option. If it trades here, obviously we'll be stopped out of our long position, but we can now go short if we'd like. Or if it trades up here again, well, we can buy some more shares if we want. It's up to us. So let's see what happened. Well, 2 days and nothing happened, but then on the 3rd day, we traded at the bottom stop first. So we were out of the buy signal, and now we're short. And look what happened, okay? We see this happening over and over again with technique C. This is where you have this coiling effect, where you have a buy stop on top of a sell stop. It doesn't happen all the time, but when we see this, it's a high probability technique C. And then we're going to go into detail and share with you more ways in which to trade this in the course. Now, one last example of this specific technique in the spiders. This was just this last month. We all know the market this past month has been going strongly to the upside, okay? 5th, 6th, and 7th of April, what do we have here? Not much action, kind of going sideways. When we apply the dynamic stop, we click on buy and sell, and we have a strategy, or I should say a technique C. A strategy means that you come with all the buy, sell, stop placement, exit point. A technique is just highlighting the high probability point for entry. So we know here now that if we trade above here, we're going to go long. If we trade below here, we're going short. So the first day, nothing happened. We're still in the range here. Now look at the next day. Here's where we'd buy. Actually, you'd buy a little bit higher because we gapped up. So you'd place your stop here. If you were wrong, you place your stop here. And we all know the market has gone up. And then another second technique C setup was generated on the 14th, and you could have bought again. So just off this 2 weeks, we're talking about 700 Dow Jones points to the upside. You could use this as a market trend identifier. You don't actually have to trade the spiders, which is the ETF or the S&P 100. You could use this on the QQQs as well. So if you see a technique C setup and we break out to the upside or the downside, most likely that's going to tell you what the market's going to be doing. So this is a great way to apply this. And I just wanted to share with you the basic foundation of this technique, just to give you a little taste of how powerful these techniques are going to be. Remember, these are more advanced. We're going to share with you how to trade them, how to spot them in the part 2 of the course. Okay, so let's review. What did we talk about today? How are PTS dynamic stops different from the others? Well, obviously, they're based on market behavior. Remember, we are not bending the market to our view. We are bending our view to the market. We are not telling the market, don't go lower than my risk of $1,000 because I don't want to lose $1,000. So please don't go any lower than that. The market doesn't know or care. Doesn't know or care how many points, excuse me, or how we feel that day. It will do what it wants. So we have to bend our view to the market. Therefore, these stops are designed to keep you in winning trades as long as possible, as you just saw. They're also focusing on minimizing your losses. Not every trade is going to be a winner. The market can change its mind at a drop of a hat. we have to be able to minimize these losses, and that's another one of its main focuses. There's nothing to calculate. That's the beauty of it. Once you click on the stop, either the buy stop or the sell stop or both of them, all the stop levels are auto-generated. They will continue to be generated as the trade unfolds. You can apply this to any market or time frame. Remember, I focused mainly on stocks today, but I showed you a couple of examples, one in the Swiss franc, another one in the Dogecoin, and another one in an ETF, the Spider. So it doesn't matter what market or what time frame. And then lastly, as a bonus, we're giving you 3 different ways to initiate trades by applying the PTS dynamic stop levels, okay? These are more advanced, they're PET-D required, but they really are ways to take your trading to the next level by using these stop levels as a benchmark for entering a trade. So here's what I want you to do right now. Go back and look at your last 10 to 20 trades. If you're getting stopped out too early, if you had a trade and you got stopped out, then it turned out to be a winner. Or if your risk is too high and you're saying to yourself, gosh, why do I losing so much? Why didn't I just have a smaller risk? You need to be a member of the Dynamic Stop course. Will really help you, will minimize your losses, also will help you to sustain those nice winners. That's our goal. All right, we have a special attendee offer for all of you coming and hearing me speak today. Obviously, we're going to offer you great discount to our Dynamic Stop 2-part course. This is a full day live class, but we're breaking it up into these 2 parts. Remember, the first part, we're going to be talking about the application and the basic issues traders have with stop placement. In the second part, we're going to have a more advanced class where we're actually going to be talking about trading with the dynamic stops. You can apply this to any strategy, market, or time frame. They're based entirely on market behavior, and you're also going to get 3 proprietary trading techniques. Now, as you've seen, everything was displayed and calculated using the PTS Primo charting platform. Everything is 1 click away. There's nothing you have to do. We've taken all the hard work out of it for you. It's a proprietary tool. All you have to click on is if you want to see the buy stops or the sell stops. Now, we want to give you the availability of having our platform. Now, normally a year would cost you close to $1,800. We're going to discount that down for you so that you can use it and be 1 click away. In fact, we're going to discount it down to 0. You're going to get 12 months free, but you have to sign up today, all right? Very quickly, or in the next 24 to 48 hours, all right? Because, you know, we have so many more features applicable on the platform, such as automatic exit levels, such as the buy-sell line telling you the overall trend, so many more features. And we just don't want to give this away unless you're really serious about it, becoming a member of this very advanced course. So let's break this down, okay? The 2-part course, which is a live 1-day course altogether broken up into 2 parts, includes also 1 year of the PTS Primo charting platform. Normally, this pre-launch would cost $39.95. So we're talking about close to $4,000 along with nearly a couple of $1,000s for the platform. Well, we're going to discount that down 25%, down to $29.95. You're going to save 25%, a full $1,000, which also includes that free 1 year. We're also going to include payment plans. So you're going to get payment plans as well. If you can't come up with $29.95 lump sum for a small deposit, you can still be up and running and in the class. We're going to start the class very soon. So if you're thinking about it, a payment plan may be the way to go. So please remember, this is a special 1-day live event. Class size is limited, so reserve your spot now, and you'll be able to be up and running and learn exactly how to use our dynamic stops. All right, here's how to take advantage of this. Contact my sister site, Pro Trader Strategies. They developed the platform with me. They're in charge of all the pricing, the course discounts, as well as the payment plans. Once again, as always, I would suggest calling them up directly at 310-598-6677 and ask for more information about a payment plan. For a small deposit, you can be up and running. They're very flexible. There's absolutely no obligation. They'd be willing to give you an estimate so you can think about it and come to the decision on your own. But they're there to help you and to work with you. So give them a call. That's probably the best way to go. Now, that link you see at the bottom is the link that will take you to the information page on this new course. And as well, you can sign up for it on there as well. But it's not live. So we are posting a live link as I speak on the chat box of the GoToWebinar column. So if you look at your GoToWebinar column on the far right, underneath chat, you'll see a live link that's been posted, and that will, all you have to do is click that on. You don't have to copy and paste anything, okay? Now, I promised I would reserve the last 10 or 15 minutes for any questions. If you happen to have them, please ask me a question, and I promise I'll answer it to my ability. I see some people here had trouble with their audio, but they turned their computer off and on, and it's fixed. Great. Okay, thank you. Yeah, that works a lot. It's oftentimes it's your own internet connection. Someone is asking, do I have to have the PET D? Well, yes, if you want to trade these 3 advanced ways with the PTS dynamic stops, yes, you do, because they all include using the PET D. But once again, Pro Trader Strategies is very flexible. We know that a lot of our students are repeat course takers and that you already may have the PET D, so that may not be an issue for you. But if you don't have it, contact them. Once again, they're very flexible. They'll be willing to work with you just to become a course member. I'm sure they'd be willing to give you a deal. The PET D by itself anyway is a great tool to have anyway. So just by picking up the PET D as well, you'll have such a great arsenal there in your trading plan. Okay. Here's my most common question I always get. What do you mean by educational correspondence? Educational correspondence means you get my personal email address. You can contact me whenever you'd like. So we have students that are, sometimes they don't fully understand a process or don't understand how to apply something. So I always just say, listen, you're a student of mine now. You can use my personal email. Contact me whenever you like. And students email me over the weekends. Sometimes they'll email me in the middle of the night. So there's really nothing that you can't ask me that I usually get back to within the next 24 hours, okay? Next question. I trade E-mini futures, well, so do I. That's makes 2 of us. Using hourly bars. Should I use all 24 bars or just bars during cash hours? It really doesn't make that much difference because the dynamic stops are so sensitive. You don't need that. Really all you need is maybe about, I would say on hourly bars, I'd say maybe 5 or 10 bars at the most, so don't quote me on that, but I really don't think you need all of that much information, okay? It all depends, though, how you want to trade them, because I know by trading the E-mini, and sometimes I'll see it overnight, the bars and the setups are going to be different on an overnight session as if you continue on to the regular session. So for that overlapping period, they will be a little bit different than if you just start the regular day session. So just take that into consideration. Don't think that you're going to see the same stop placement in one chart as you would in the other, because there's different market behavior going on in both charts. All right, so that's just one thing I want to let you know. But I mostly this is not in any way telling you how to trade, but just as a bit of reference, I am mainly using now just the regular session. Okay, so it's up to you. But when I apply these, I use the regular session. But once again, if you find that you have more consistency using the overnight, including with your dynamic stops, that's great. That's fine. Okay, feel free to do that. Everyone has their own way, and that's what we want. But the worst part is it doesn't matter what time frame or what market. The worst part is using those standard stop levels. And once again, that's off of dollar amount, off of point amount, or off of just a random amount. You have to be in charge by choosing market behavior, not your behavior, okay? You're more than welcome. That's what I'm here for, to answer any questions you may have. Another question, when is class starting? Well, this is our first informative webinar where we're announcing. So we want to give people time. It would be, I would say, within the next week or 2. So it's not going to be like, 6 months from now. It's going to be very soon. And, that we want to keep size to our classes, which we've done before in a lot of our courses, to a very intimate level. We don't want, when we first started doing our courses, we let everyone in one single class and we'd have 60, 70 people. And that's just far too many people to really get intimate and to ask questions and to feel as if everyone understands the process. So we want to keep them to a certain size. If we have so many people signing up, we'll have a number or series of different small classes. And I've done that before as well. I've had 2 or 3 different sessions going on with different people lined up in different classes. So we'll do it that way. Someone's asking, when will the classes be? What day? Well, we usually have our classes on Fridays, roughly from 10 to noon. Sometimes they've gone even to the close of the day, depending on how many questions there are, how much information I'm covering. But the minimum usually is an hour, and the average is roughly about 2 hours. because this is a 2-part course, it'll probably go closer to 3 hours, okay? Now, if that doesn't work, remember, it's a majority rule here. If we have 20, 30 people in the class, and most of the people say, listen, that's not a good time for me, we'll be very flexible. We'll shift it to the weekend if you want. We'll have it before the opening if you want. If you want to have it on Monday morning, it's perfectly up to the majority of the students. Usually Friday works out pretty well, and for the main reason because if you have a Friday class, then you get the weekend to go study and research all the things that were presented in the class. But it's only a 1-day event, and it's broken up into 2 parts, okay? So that's just to clarify exactly how it's going to be. Okay, if there are no further questions, I hope you got a good idea as to what we're offering. And now I think after seeing the examples, I'm sure a lot of you are relating to the same issues that most traders have, and that your strategy really isn't that bad, or your trading technique. It's just that your stops are really faulty. You're getting out too early, or they're stopping you out with too much risk. So if you want to really hold on to your profits, or at least cut your losses to a minimum, the dynamic stop is the way to go. Secondly, it's so simple on our platform. Everything is 1 click away. Click it on and it will automatically generate these stops as you're in the trade, okay? Remember, contact Pro Trader Strategies if you have any questions concerning pricing or discounts, or most likely establishing a payment plan. That's my suggestion. I would really go in that direction, because you don't have to come up with all the lump sum. You can come up with a small deposit and you can still be in the first class, okay? As we close, I just want to say thank you so much. I hope you really learned a lot more about what's being offered and what I'm going to be teaching in this class. And as we take one last look at our disclaimer, thanks so much for attending today, but mostly I look forward to all of you being the initial students in my new dynamic stop course. Thanks for taking the time out to hear me today. I'll see you in class. Bye-bye.